Hello friends, imagine a company using its shareholders' money not to grow business but to buy out the promoter's family assets. That's just what Satyam did in 2008 and it backfired spectacularly. Hi, my name is Pratheej and welcome to Deep Dive into IFRS. The time is around 2008. Satyam is one of India's IT giants and India's poster child when it comes to IT outsourcing. But suddenly the board announces a plan to acquire two companies, Maytas Infra and Maytas Properties. But if you see Maytas, Maytas is Satyam spelled in reverse. So these were actually promoter-related entities controlled by Raju's family. And the price tag for acquiring this was about $1.6 billion. And that was almost the entire cash reserves of Satyam. The justification given for this was the company wanted to diversify into real estate and infrastructure. But the problem here was that neither real estate nor infrastructure were directly related to Satyam's core business, which was IT. So what was really happening? Weeks later, Raju admitted that Satyam's balance sheet had fictitious and fake assets, whereas Maytas' balance sheet had real and tangible assets. So by Satyam acquiring Maytas, by transfer of cash, these real assets would come into Satyam's balance sheet. So in accounting terms, Raju was trying to plug a hole in the balance sheet of Satyam. In 2008, there was no IFRS in India and there was no Ind AS as well. But still, I am using this IFRS angle to make you understand the concepts in IFRS by linking that to a real life example, which is very popular. So let's see where IFRS comes into picture in this case. Number one, commercial substance. By acquiring Maytas, Satyam's shareholders were not getting any new synergies. It was just shifting money from one promoter pocket to another. So as far as commercial substance is concerned, if a transaction does not change any risk or return or it does not result in any future cash flows to the entity, it should not be accounted for. But it was done in this case. Number two, reliable fair value measurement. For a transaction to go through IFRS, the fair value should be reliably measurable and it should be market driven. But in Maytas assets case, that is the land bank that Maytas was holding, the value was highly inflated so that when they were brought in and the cash was transferred from Satyam to Maytas, everything would be smooth and everything would be rosy looking after that. So as this was done, the reliable fair value measurement was also compromised. Number three, related party transactions. IFRS requires full disclosure and independent approval when dealing with related parties. Here on one side of the table it was Satyam, on the other side of the table it was Maytas. Both belong to the promoter. So the independence test failed completely. Number four, substance of a form. The idea that Raju was presenting was Satyam is acquiring these two companies for growth. But the substance behind this was to plug the fake accounts, to replace the fictitious and fake assets of Satyam with the real and tangible assets of Maytas. So the transaction, the whole buyout procedure was in direct violation to substance of a form. The collapse and the lesson. There was huge public outrage. Raju was sent to jail. Government of India had to step in. They appointed a temporary board to solve the issues. They made sure that Satyam's employees did not lose their jobs. And finally, after a prolonged bidding process, Tech Mahindra took over Satyam and now it's running smoothly. So what is the lesson that we learned from this? Any acquisition has to be governed by majorly two principles. First, does it have commercial substance? Number two, is the fair value reliably measurable? Satyam failed on both the accounts. So this is a classic example of how corporate governance and IFRS principles should go hand in hand. I hope this video was useful to you guys. Till I see you in my next episode. Thank you for your valuable time.